Hi, I'm Indranil and I'm very happy to bring this stock trading course, and I'll be discussing the introduction part today, at least a part of it. And over past 6-7 years, I've perfected my technique of stock trading, and it is extremely profitable. And of course, I'm not saying that everything can be learned as quickly, but definitely I take you step by step, and things will start, coming together towards the end of this course, where I will explain my final technique and uh, how to take trades and how to take profit. Okay, so as I said, this is just an introduction to stocks and stock trading. So what are the advantages of stock trading? So these days, engineers, doctors, everybody has a skill, and the skill is that uh, they can do a job very well. But unfortunately, even that it does not guarantee you a job in 5 to 10 years time. And eventually, if you do have a job and you've been very secure in a company, 5 to 10 years down the line, you'll have a very high salary, and the company always looks at their profit, and you may not be profitable for them after a certain time. There may be somebody younger than you who can do the same job for half the price. So what do you do then? So that's where trading comes in. You can trade from anywhere in the world, and that's the advantage. I know people who trade from Thailand, Venezuela, US, wherever you want, they're trading from there. So that's a major advantage. So it's extremely low risk. As for example, if you compare it with the restaurant business, you need to first get all the raw material. You need to have a good cook. Then you need to hope that people come to your restaurant and actually like the food. So this is not like that. You only risk a certain amount of your capital, 1 to 2% of the total capital. You take the risk. You risk only that much. Take a trade that you have an edge on, where you have checked based on your technique. So you take a trade. If you lose, then you lose that 1%. But if you win 2%. So that means even if you have more losers than winners, you can still be profitable. Flexible work timings. The US stock market works from 9:30 to 4 p.m. And after that, you're free to do whatever you want, free to be with your family. No hiring and firing people, which I of course hate, and anybody else I'm sure would also hate. And no rentals, no inventory. I know people who trade with $500 and they have converted the 500 to $100,000, sometimes even more. I'm not saying that it's possible, and I'm not saying it's possible in such short period of time, but with practice, everything is possible. So, what exactly is a stock or a share? A stock, it is the share in the ownership of a company, including a claim to their earnings and assets. Stocks like Apple, everybody has an Apple phone. Amazon, we order all things from Amazon. Asian Paints, these are Indian. This is an Indian stock, HSBC. So shares, they are a unit of stock issued by a corporation that it represents their ownership. When they need money, they are sold to the investors and traders. Investors and traders are us to raise money for the company. In simple words. So what exactly is a ticker? It's a symbol of a company. Like, for example, Amazon. We know that Amazon is a company, the name of the company, but ticker is a short form of that particular company. It's like a symbol which is a short form. So Amazon ticker is AMZN. Same way, Apple is AAPL. These tickers you don't need to buy heart. Gradually, when you start trading, you will know the tickers of all the major companies. So how do you make a living, make money in trading? Now, whenever you see a stock, the stock can either go up, it can go down, or it can go sideways. It can go in only three directions. So going long is when you expect a stock to go up. When you are contemplating that, when you are predicting that in the near future or in the future, the price of a stock is going to go up, that means you are going to go long on that stock, or in stock trading terms, you are bullish on that stock. The opposite is bearish. When you expect the price of a stock to go down in the near future, that means you are bearish on the stock, and that's called going short on the stock. The advantage of trading is that you can earn money both ways. When the price of the stock goes up, you go long. If the direction that you chose was right, you're going to make money. But if the price of the stock falls and you knew beforehand that it's going to fall and you went short on that stock, you're still going to make money. So it's like a business. Going long is buying low and selling high, buying low and selling high. So here we are not buying any physical assets. It's just financial assets like stocks, ETFs, currencies, forex is currencies. So the aim of this course is that to learn the probability that a stock will go in a certain direction and betting on that probability. I'm going to teach you that, and that's what the whole course is about. Now, the buying and selling of a stock is done by stockbrokers, and that I personally use a company called Interactive Brokers, and they charge a certain commission per trade. So when you calculate the profit of your trade, also the the commission needs to be taken into account. The commission can be anywhere between $1 to $5. The lesser, the better, and that means the lesser money you're losing to the stockbroker. So stockbroker has to be selected very carefully. So as I said, you so this is shorting a stock. Shorting means you sell high and buy low. So basically, for example, you sell a product to a customer, collect the cash, and make the same thing at a lower price. So people may be confused a little bit as to what does this mean? How can you sell something before you buy it? So what the broker does is he lends shares to you to sell at this high point. Suppose you're looking at the stock at this point. You don't know what has happened here. All this has not happened. You're looking at the stock at this point. You think that it might go down. You have a feeling. So you tell your broker, and the broker, you hit the sell button, and the broker immediately within half a second lends shares to you to sell. Now, if somebody lends anything to you, of course, he wants it back. So you need to buy the shares that were given to you by the broker at whatever price the stock goes to. Now, if it goes to your predicted price, which is goes lower, then you buy back at a lower price and make a profit. That's the profit. But if you were wrong and the price goes up from here, you still have to buy back the stock, but now you'll be buying it back at a higher price, and you'll be that will be most of our trades are going to be going long on a stock when we will be bullish. Few of our trades when the market is extremely down and everything is going wrong with the market. That's when we will make money by going short. So, for example, in this uh, chart of the ticker Apple, if we bought this, if we were looking at the chart at this point, and we don't know this has happened, whatever is on the left has happened, whatever is on the right would not have happened. Suppose we are on this at this point. The price you can see it was at 130 on this day. If we went long on the stock went up and finished at 193. That's crazy amount of profit. That's how you make money in the stock market, by predicting which way the price is going to go and then pulling the trigger either towards the long or towards the short position. If the trigger has been pulled in the right direction, so this is going short. So just an example that the broker gives, the stock is at $30 here, see $30, and you wanted to go short on this. So you sell $30, 100 shares you sell. So you totally spend $3,000. So basically, you don't spend $3,000, but the broker gave you stocks worth of shares worth of $3,000. So this sort of trading, which is going short, has to be done with something called as a margin account. Margin account. There are two types of account: cash account and margin account. Cash account is it helps you to go long on the stock, but margin account is for more I would say seasoned traders. Let me put it that way, who are more experienced in going short. Because as I mentioned, going short can have disadvantages. If the price goes in the wrong direction, then you need to cover your position, meaning you need to buy the stock back at a higher rate, and you lose a lot of money. So that's why a margin account is required, where you need to have a minimum balance of approximately half the amount that the bank or that the brokerage company is lending you. Sometimes even the full amount. Without that, you don't get to sell a stock before buying it. So we will be starting off with a cash account. I always, before opening a cash or margin account, I always advise that you should first do paper trading. So when you open your account with Interactive Brokers or whichever from wherever you want to trade, they will first give you for 2 to 3 months a virtual account with virtual money in it, and you can trade the real markets based on this virtual money. So it's like flying a plane on a simulator. You can crash 100 times, but you will come to know what technique works where, even a single dollar to trade. So paper trading for 2 to 3 months till you prove yourself profitable with the paper money is very, very important. So instruments, there are different instruments that you can trade. They are, like restaurants. There's an Indian restaurant, Chinese restaurant. Both will be profitable. They have Indian restaurants may have more of Indian clients who like Indian food. Chinese restaurants work differently. They have Chinese food, but still they also will be profitable. So you have to find your niche. We mainly trade in stocks. It's much more easier. Many people they prefer currencies or forex. It's open 24 hours. Stocks is not open 24 hours. Options and futures, they have expiry dates. They are contracts. They are much more. You can win more and you can lose more. So I don't suggest doing that. And bonds. So basically, the aim is to master instrument that you plan to trade. And each instrument has, like I said, like the restaurant analogy, each instrument has advantages and disadvantages. So this is a very important graph. This graph I have taken from a very profitable stock trader, Adam Khoo, and so you know this what it shows is that this book is a very interesting book. If you get time, you should read it. It shows people who have no background of financial analysis, nothing of that sort. They also can be very profitable. Housewives can be profitable if the winning system is taught to them. So it's basically 10% is a winning system, which over just not one or two trades, but thousand trades. Thousand is the number. Over thousand trades, you win more than you lose. You can lose 10 trades in a row, but if over thousand trades you're profitable, that means over the long term you'll be profitable. So the 10% of the important thing here is a winning system, which I will teach you. The Let's go to this slide. Sorry. Yeah, 30% is how you manage your money. You don't, the amateurs or amateur traders, they love putting their entire money on one trade. You cannot trade like that. You have to, it is all about risk management. Most important, is sometimes even better than your system, more important than your system. You can only trade with 1 to 2% of your total capital. If you lose that 1% so that you can still be in the game. And 60% is psychology. You have to be like a robot when you trade. Kids can trade very well because they can follow instructions, they can follow strict rules. For us, losing money and pulling the trigger of losing and coming out of a trade seems more difficult than a kid teaching the same thing to a kid. They are sometimes more profitable because they follow rules. So if you have rules, follow them and you'll be profitable. This is the entire way to be profitable. Okay, so there are different time frames of trading. If he was a very good trader in India, Rakesh Jhunjhunwala and Warren Buffett, they were positional and swing traders. Positional trading is long-term holding for months. When you hold a stock and you don't care what happens to it during the day or during the week, you hold it for 6 months, and 6 months you take the profit. Swing trading is what I do. It's basically you hold it for certain days, 2 weeks to maybe just a few months. That is swing trading. I feel the maximum money is done with swing trading through swing trading. Day trading is for people who are extremely quick. They want quick money. They will check candles which are for minutes or sometimes even seconds. So uh, and holding period is same day. So you buy in the morning, maybe sell within a few hours. And scalping is you buy 5 minutes back, the candle 1 or 2 minute, you hold the stock, price goes up and you sell it. Based on who you are, what type of person you are, you need to decide what type of trading you want to get into. If you look at Tiger Woods, now Tiger Woods is a very good golf player. If you tell him to maybe be a bike racer, will he be good? That is also a sport. This is also a sport. No. Same way, if you ask a bike racer to start playing golf, golf is a slower game. Even though he may be a very good bike racer, he may not be good at golf. So that's how you have to decide for yourself based on the amount of money that you have and how soon can you check charts. You have to decide on this. So there are different styles of trading. There is a technique of fundamental analysis where some the trader checks the balance sheet of a company, fundamentals of a company, profit loss, how much is profit and loss. All that is fundamental analysis. What we do is technical analysis where we check the chart of a company and we check based on different indicators, different things, only the chart. And then there are traders who check macro trends, GDP, interest rates, and then take a trade. So there is no right or wrong. Find your style. I will be teaching mainly technical analysis because I feel the maximum money is made here. So we read charts through using a website called tradingview.com. You can open a free account or it's ideally you can pay for it as well. The free account has few restrictions. However, it does allow you to start practicing seeing the charts of your favorite stocks. Let's start. Here, when you open TradingView, this is the chart that you get. You click here and whichever stock you want to see, you type the ticker of that stock. Suppose Apple. This is the ticker. Nasdaq is the US market. So you select Nasdaq. This is the UK market. This is all different. So you select Nasdaq. So the chart of Apple opens up. You have these different time frames here. Starting M is monthly, W weekly, daily, 4 hour, 2 hour, and so on. You can click here and even customize what time frame charts you want to see. Suppose you click M or monthly. Yeah, one thing I forgot. This is a candlestick chart. The way we can see the price of a stock is by using either a candlestick chart or you can use a bar chart. See, this is candles. If you click here, this is candles. This is a bar chart, and there are other options as well, like a line chart. We prefer a candlestick chart because it gives you maximum information on how the price is moving for this particular ticker. When you click on the monthly means that each candle that you see denotes one full month of price movement. As you can see, when I'm moving the cursor of my mouse, there is one vertical line and one horizontal line. The vertical line that passes through a particular candle, it tells you at the bottom the date of that particular month of this candle. So if you see down here, it's 1st September 2023 to 2nd October 2023 was this particular candle movement, price movement. Next month, this candle started from 2nd October to 1st November 2023 was this candle, then this candle. If you click on weekly, each candle denotes the price movement that happened in that particular week, and the vertical line that passes through a particular candle tells you the date. So the difference between each candle, it will switch in per week. If you notice, 22nd April, 29th April. And the horizontal line, it tells you the price. See the horizontal line, the price on the right side here. The price 173, 182. That's the price that the stock was at. Now, how do you read a candle structure? I'm just zooming in on this weekly candle on date which started on 29th April 2024. This is a green candle. A green candle indicates that it's a bullish candle. Bullish, like I explained, where the bulls were in control. Bulls were people who are positive about a particular stock. Bears are people who have a negative expectation of the stock, and they cause a candle to turn red in the price falls. So let's talk about this candle. Green means the price on that week, it ended higher than what it had started with. A green candle always, the open of the candle where the week began was always at the bottom, is always at the bottom of the body of the candle. Let me explain again. This is the body of the candle. These are the wicks of the candle. Body, the lowest point of the body is where the price started in the beginning of the week. Then the bears who wanted to push so the price started at the horizontal line here at 173.64. So Apple was at 173.64 on the day of 29th April. Then what happened? During that week, the bulls who wanted the price of Apple to be pushed down, they pushed the price down. They kept selling Apple rather than buying it, and there was more selling than buying, and the price got pushed till this wick, which is 169.43. So the price reduced from 173.64 to 169.43. After that, the bulls again took control and pushed the price way up till this wick, which is 186.99. But then what happened was the wick is an indication that the price could not stay there. So the bears or the bearish people pushed the price down, and the price closed here at 183.33 for the week. So a green candle, the open is at the bottom of the body and the close price is at the top of the body. The wicks are where the price could not stay. This is an extremely bullish candle because the body is bigger than the wick. The next, and the red candle is exactly opposite. The open is at the top of the body at 170. Suppose we're talking about this candle which started on 15th April 2024. It opened here at 175.28. During the week, during the week, the bulls who wanted the price to go up tried to push it till here. This is a wick, tried to push it till here to 176.75, but the bears took control and they did not allow the price to go higher than this. They pushed it down, down till here. I'm just making this bigger, the same candle till here, 164.07. The bulls then took control and the week ended at 164.96. So basically, in a red candle, the open is at the top of the body and close is at the bottom of the body. This is an extremely bearish candle because there's a large price movement which started higher but ended lower. This is an extremely bullish candle, started lower, ended higher. If you click day, D, that means each candle is 1 day candle. So every day there is a candle. If you notice, the date is changing every day. So this is how you read candles. So suppose you are here on this day of 23rd April. Let me make it big. Price started at 165.27, went down to 164.95, came up to 167.36, and finished the day at 166.85 maybe or 91. Next day, the price opened here at 166.53, went down here, came up, finished here. Next day, price opened here, fell down during the day, went up during the day, ended here. Next day, price started here, got pushed up, could not stay there, got pushed down by the bears, finished here. Next day, the price gapped up. Gap up is when the market is not open during after hours. There is a lot of buying and the market opens much higher than when it was it had closed. So there was a gap up. Started at 173, got way extended till here, then got pushed down by the bears. Next day it started here, pushed up, pushed down, like this. So this is how you read the candlestick chart, and this is just the absolute basics. Gradually, I will discuss more in detail about the different things that are there here. Hope you enjoyed this video. Comment and like and subscribe.